Good morning, everybody. This is Patrick MontesDeOca with the live trading room for the Equity Management Academy. This segment is brought to you by the Equity Management Academy. On this segment, we're going to take a look at the report that was published last week, the weekend of the 3rd, and we're going to examine and take a look at basically what transpired last week. On the report, if we take a look at the gold market, it was anticipated that the price may come down to as low as 1182 to 1173. Based on the fact that the market closed below the weekly price momentum indicator of 1199. By closing at 1191, it was expected that the market would come in bearish, and it suggested for you to cover your short positions between 1182 and 1173. If you cover those positions, it also told you that if you went long, that you should take profits anywhere between 1208 and 1225. Why don't we take a look and see what happened last week and be able to identify the effectiveness of the algorithm. The report was written on the 3rd, and it told you that on next week, if you come in, that the low possible was 1182 to 1173, and in fact the low for the week was 1183.30. It was pretty close. And then it told you that if you went long at those levels or near those levels, that profit should be taken at the 1208 to 1225 level. Let's see what happened here. Obviously, with the market opening low on Tuesday was the bottom, and it rallied basically on Thursday to a high of 1223.90. So it took out the first target of 1208, and it gave you an opportunity very close to that 1225 target if you wanted to initiate a profit. So we pretty much caught the move from about 1183 all the way up to 12. On the high on Thursday was 1234. Actually, 1234. So it took out both targets, meeting the objective of last week, expecting the market to rally as it did. Now, let's take a look at this weekend's report, which was just published a few minutes ago, and see what the algorithm is telling us to expect for next week. What I'm going to do is I'm going to basically use the weekly VC indicator to give us an idea of where we closed on Friday and where we're going. The market on this past Friday closed at 1223, and the market closing below the 9-day moving average of 1247 is confirmation that the weekly trend momentum is still a little bearish, and a close above 1247 will pretty much activate, based on the moving average, a neutral to bullish indication. Now, our algorithms basically are telling us that with the market closing above the VC weekly price momentum indicator of 1213, it confirms that the price momentum is bullish. And a close below the VC weekly, it would negate the bullish signal to neutral. It's suggesting that if we see a correction to cover short on corrections into the 1193, which you see here on this blue line, and 1163, the bottom end of the range. The fact that the market closed at 1213 is bullish. It shows here on the chart that we've closed above this price for 3 closing prices in a row. And that is a confirmation that we are moving into the next target, which suggests to take a profit at about 1243 to 1264. So what we expect next week is a continuation pattern that will take us to the targets of 1244.50 to 1264. And it recommends for you to take some profits at these levels. Let's take a look at a little bigger picture here and see, by using the weekly indicators, what the longer term picture looks like, and where potentially we could be headed for if in fact we do close above this resistance levels of 1264. And for that, we go back basically to the all-time high that was made back in 2011 of 1804, or I would say actually November 7th, 2011, the high was 1804. And we're using that high as the measurement point for us to do basically a Fibonacci retracement connecting to the recent lows that we made last week. And above 1264, we get the first target, Fibonacci retracement of 23.6%, which is 1328. The next target above there puts us at about 1404, and it matches basically the downtrend fan line, Fibonacci fan line resistance of 1404. Above there, we're looking at a 38.2% retracement Fibonacci of 1419, and above that, we're looking at a 50% retracement matching the fan resistance lines of about 1493. The upper end of the correction points us to about 1566, and that's the major long-term resistance Fibonacci trend line that matches the golden ratio Fibonacci retracement of 61.8% retracement. Breaking above this level here, we're looking at 1671 to 1805 targets that essentially confirm to be challenged. So it appears that we are making a major triple bottom. We have a descending wedge pattern building up basically down here that indicates the market by closing above 1213 with a close of 1223 on Friday, that the market has put in a key reversal signal weekly, which is a very bullish signal on a weekly basis. So let's review once again the fact that the market closed above the 1213 VC code indicator weekly is confirming the next target to be 1243, 1244, and above there 1264 for next week. The support, we're looking at 1193 as a buy one level, and the B2 level as low as 1163, which would be making a new low if that was to be the case. Based on the closing of Friday, I doubt very seriously if the market will have the ability to go down to 1163. But if it does go down to 1163, it probably would be an extremely oversold condition, and recommended to cover all short positions and reverse to long would be the ideal recommendation if that's to be the case. Let's take a look now at the silver market and see what the picture looks like. In fact, once again, if we review what we did last week, we can have a pretty good idea of where we're going next week. The market last week closed at 1191 on Friday, October the 3rd, and it had a bit of a bearish overtones based on the fact that it was below the moving average of 1266 and below the VC indicator of 1199. But it also told you that if you're short, you want to cover your positions at 1180. I'm sorry, this is for the gold. That you want to cover your positions. Let me go back here for a minute. The VC weekly price momentum indicator was 1704 for the silver, and closing below 1704 was bearish coming into the week. It told you that you should cover your short positions at 1644 to 1604 if you're short. And if you reverse from those levels, that you should use a stop of 1604 for the long positions, and take profits in the 1744 to 1804 levels during the week. That was this past week. On Monday the 3rd, the market made a low of 1664. That was pretty close to the expected low of 1644. If you purchased anywhere nearby, they told you to take out your profits at 1744. But the clue, and I said that on the last podcast, was if the market closes above 1704, it puts into place the targets of 1744 and 1804. In fact, the market closed on the 6th at 1734. So it obviously confirmed the uptrend. And on the 7th, we made a high of 1762.5. And a new high was made on Friday of 1772. And so you can see here that this algorithm gave you the direction of the market for last week to be up. If it closed above 1704, it was a trigger to buy with targets of 1744 to 1804. Now, let's see basically what happened or what's going to happen next week as we review what was published here today, early today. On Friday, the silver market closed at 1739, and the market still below the 9-day moving average of 1846 is confirmation basically that the trend momentum is bearish. A close above 1846 would negate this weekly bearish trend and would neutralize basically the bearish short-term trend. With the market closing above the VC weekly price momentum indicator of 1726, it confirms that the price momentum has turned bullish. And a close below this level of 1726 would negate the bullish signal to neutral. It also told you that if you come in and you short, to cover your shorts at 1679 to 1620. Your stop level for any long should be 1726. A close below would probably bring the market down to 1679 or 1620, which it recommends to buy at those levels and put a 1620 stop. It also tells you that if you're long, take profits at 1785 to 1832. The low last week was once again in silver 1664. The close obviously closed above the VC price momentum indicator of 1726, and so we expect that the market should rally all the way up to 1785 to 1832, where we recommend for you to take some profits on the swing trading indicators that we have. This is a weekly swing trading instructions for the futures contract. And so, once again, the fact that the silver market closed above 1726 projects the market to rally to 1785 and 1832, at which point you should take profits. If we close below 1726, you should stop out of your long position and look to buy it back at 1679 to 1620 if given the opportunity, and use the 1620 as a stop close only. Let's take a look into silver and see basically what we can expect next week, and using the algorithms for next week. In here, you can see clearly that the market closed above the 1726 VC code algorithm, and closing here now. This is for 3 days in a row, is very strong confirmation that the target of 1785 to 1832 more than likely will be tested next week. We also closed above the 9-day moving average in here, and that's pretty bullish indication. If we come in under 1726, then the target on the downside is 1679 to 1620, where it recommends to buy the market into these levels here with a stop at 1620. The low that was made last week was 1664, and so what this is saying basically is that the market is recommending to buy into this area once again that might be extremely oversold, with a maximum downside objective of 1620 for the December silver. Let's take a look at the weekly chart and see what we can expect here if we in fact do break out of this resistance levels of about 1832. In using the Fibonacci fan lines, basically from the high that we made back in February of 2012 of 3758, connecting it to the lows, we get very specific price levels that indicate that the market first target is 2140 by using the Fibonacci retracement. The second target is 2451, which matches the Fibonacci fan line resistance from the highs of 3758. The 50% Fibonacci retracement is 2702, and the golden ratio 61.8% retracement is 2954. Breaking above this level, it indicates that we could rally up to the 78.6 retracement of 33.11 with an ultimate target on the upside of 37.58. And obviously breaking above here would put us in a completely different fractal in price. It's pretty clear that very strong synergy between the Fibonacci trend lines and the Fibonacci retracement match the numbers that I just went over, and so you want to keep this picture in mind and continue to see the market rejecting new lows from here, and ideally moving above the 1832 level would be extremely constructive for next week. We will review this information next weekend and see basically what happened the coming week, and look to position ourselves and assist you in positioning yourselves for the following week. Once again, this is Patrick MontesDeOca with the Equity Management Academy. Until next time, my friends, good trading and take care.